Is it possible to retire a multimillionaire with just an S&P 500 ETF? The answer is definitely yes. What's up, ladies and gentlemen? Welcome to the Beat of Business with me, Ravi Wadan. And today I want to talk about a question that I get often, and that's whether or not you can really retire a multimillionaire with just buying an S&P 500 ETF or an S&P 500 index fund. The short answer is yes, but there are definitely some things that you should know about. I don't want to be a drag, but retirement for people who are in their 20s or in their 30s is going to be extremely expensive, and it's highly likely that you'll need more than $1 million to enjoy your senior years comfortably. Times are changing, and very few workers today have access to a pension or another source of guaranteed income in retirement. And Social Security was never really intended to be a primary income stream. And with inflation and rising healthcare expenses, we are more responsible for our retirement income and our retirement savings than ever before. And one simple strategy that I've recommended on this channel, and I tell people to implement all the time, is to simply buy an S&P 500 ETF. I think a lot of people don't really find S&P 500 ETFs appealing because they think it's a very beginner strategy. Well, I'm here to tell you that S&P 500 ETFs are some of the most traded financial instruments on the planet. Hedge funds and institutional investors use them regularly, and some of the most successful investors on the planet swear by them, and everyday people like me have a bulk of their retirement portfolio in an S&P 500 ETF. Even the great Warren Buffett himself is a big believer in S&P 500 index funds and ETFs, and he's been on the record numerous times stating that it's one of the best investments on the planet. And that's why the majority of his wealth is going into an S&P 500 index fund after his death. Really quickly, let's go over what an S&P 500 ETF is for those of you that may not know or maybe need a brief refresh. An S&P 500 ETF is an investment that contains the same stocks as the S&P 500 index, and it aims to mirror the S&P 500 index's overall performance. Now, there are plenty of different S&P 500 ETFs to choose from, but some of the most popular options include the Vanguard S&P 500 ETF, ticker symbol VOO, the iShares Core S&P 500 ETF, ticker symbol IVV, and the Spider S&P 500 ETF, ticker symbol SPY. Now, you can pick any one of these funds to invest in. They are pretty much identical, and I recommend all of them. But in case you're wondering what I use the Vanguard S&P 500 ETF, ticker symbol VOO, just because its expense ratio is extremely low. But as I said before, you can buy any one of these ETFs and they will literally mirror the S&P 500 index. So if the S&P 500 index goes up 1.3% a day, your ETF will go up 1.3% during that same day. And if the S&P 500 goes down half a percentage point over the course of a week, your ETF will do the exact same thing. The reason it's called the S&P 500 is because the index is comprised of the 500 biggest companies in the United States. Now, at the time of me filming this video, the Vanguard S&P 500 ETF is trading at around $411. Essentially, that means that if I pay $411 for one share of this ETF, that one share means that I now own a small percentage of 500 of the largest companies in the United States. And if you want to know which companies those are, here's a breakdown of the holdings in the S&P 500 ETF that Vanguard offers. So of the $411 that you paid for one share of the Vanguard S&P 500 ETF, 6.17% of that will be invested in Apple, 5.89% of that will be invested in Microsoft, 3.85% of it will be invested in Amazon, and 2.35% of it will be invested in Facebook, and the list goes on. Essentially, the larger the company, the larger its percentage is within the ETF. Right now, Apple makes up the largest portion of the fund because it's the largest company in the United States. But if over the next year, Apple's share price goes down and its market cap falls below Microsoft's, Microsoft will then be the largest holding in the fund. And these allocations to these companies are constantly changing, and the names are being shifted around all the time. But the cool thing is that you don't have to lift a finger because all of those changes within the fund are happening while you sit back and relax. So now let's talk about how you can become a multi-millionaire by simply owning an S&P 500 ETF. And to understand, or to get a better understanding of how you become a multi-millionaire, let's start off by talking about the historical performance of the S&P 500. The annual return of the S&P 500 since its inception in 1926 through 2021 is approximately 10%. Now, in some years, the index may have dropped by 7%, and in other years, the index may have gained 20%. But over the course of time, the index has historically returned about 10%. And that brings me to the most important part of this video, which is the importance of time. Investing, ladies and gentlemen, is a marathon. Investing is not a sprint, and the longer you invest, the better outcome you will achieve. I really can't stress this enough, but time is your most valuable asset. So the longer you are able to hold on to your investments, the more you'll be able to earn. It's just the power of compounding. And that's why it's so important to start early, because when you give your S&P 500 ETF investment decades to build, the higher your chances are of retiring a multimillionaire without ever having to pick stocks or perfectly time the market. Most people that I know that are reluctant to invest are reluctant simply due to the fact that they don't want to lose their money. They are scared that if they invest, the market will crash and they will lose all of their money. Now, I totally understand their concern, but if you don't invest, you're losing your money to inflation anyways. But more importantly, I want to bring up something that I feel is really important because I don't think this is talked about enough. And this really goes to show you why investing in an S&P 500 ETF makes so much sense. Let's say that you are inspired by this video and you open a brokerage account on Robinhood or TD Ameritrade and you start contributing monthly into an S&P 500 ETF. Now, let's say that over the next few months, we go into a bear market and the market loses 20% of its value in a matter of months. Now, as someone who doesn't have investing experience, you are extremely terrified because you just lost 20% of your money. But I'm here to tell you not to panic because investing is a long game, and that's what I want to drill into your mind. Remember that I told you the S&P 500 returns 10% over decades. But there are periods of time when it doesn't return 10%, and there are periods of time when it drops 20 or 30% within a month or two. But don't worry, I want you to keep contributing month over month to your S&P 500 ETF because over the course of history, the market always recovers and it recovers fast. And the best example of this just happened recently. All we have to do is look at the start of the pandemic. Now, let's draw up a hypothetical situation. Let's say that you started investing at the worst time possible, right before the pandemic started. So on February 14th, VOO was trading at what was then an all-time high of $310 a share. And within a month, on March 20th of 2020, VOO was trading at $210 a share. Now, over the period of roughly a month, we had a drop of 30%. Now, at the time, it seemed like the end of the world, but look what happened from that point on. The S&P 500 and VOO, in this case, not only recovered to pre-pandemic levels, but within a matter of months, we hit some new all-time highs. And this has happened time and time again. The S&P 500 and the broader US economy always recovers, usually within months. I mean, when the dot-com bubble burst in the early 2000s, the market crashed, but it shortly recovered. And when the global financial crisis happened in 2008 and 2009, the market crashed, but it shortly recovered. So at any point in time when the market crashes, it shortly recovers. And this is why I think it's really important to not only start investing at a young age, but to contribute to your S&P 500 ETF on a monthly basis. When you contribute to the S&P 500 ETF every single month, these market dips aren't necessarily the worst thing in the world because as the market's going down, you're buying more shares, and in the end, you're just dollar cost averaging. And remember, you are investing for the long term. You're investing for decades, and when you invest for decades, you're really not worried about the bumps in the road, and you are much more likely to achieve that annual rate of return of 10%, as opposed to investing here and there or only investing for a short period of time when you're much closer to retirement. To show you why time is so important, let's assume that you want to have $2 million in your retirement portfolio by the time you retire. Now, it's really much easier than you think, especially if you start early. And to showcase this, I want to show you this chart. Now, in a nutshell, this chart shows you the number of years you have to invest for and your monthly contributions to the S&P 500 in order to have $2 million by the time you retire. Let's take a look at this chart. And here it shows you the number of years you would have to invest for. So 40, let's say that means that you're 25 years old, because if you want to retire by the time you're 65, that's 40 years. So 30 means you're 35, 20 means you're 45, and 10 means you're 55 years old. Now, in order to get around $2 million in retirement money, when you're 25, you would need to contribute $380 a month to the S&P 500 ETF. When you're 35, you need to contribute a little over $1,000. When you're 45, you need to contribute $3,000 a month. And if you're 55 and only 10 years remaining in retirement, until your retirement, you need to contribute a whopping $10,500 a month, all to achieve roughly the same amount in retirement. And one thing that people don't often talk about is when you start early, your out-of-pocket investment or the amount of money that you spend over, the 40 or the 30 or 20 or the 10 years is far less. So this person who was 25, over the course of 40 years, out of pocket, they invested $182,000. This person that has 35 years left actually contributed $378,000. And this person who's 45 contributed $720,000. And this person who's 55 and wants to have $2 million by the time they retire needs to contribute $1.2 million. So you can see that if you start early, you only contribute $182,000 versus, $300,000 or $700,000 to get the same amount of money in retirement. Again, when it comes to investing and saving for your retirement, time is your most valuable resource. Even if you can't afford that much today, you're much better off starting to invest now rather than waiting a few years, because the longer you put off investing today, the more you'll need to save later in order to catch up. By now, I hope you realize that an S&P 500 ETF can be a fantastic investment strategy, especially if you're looking for a set it and forget it type of investment that requires little to no upkeep. By simply investing as much as you can afford each month and leaving your money alone and just letting it grow, it's definitely possible to retire a multi-millionaire. So to everybody's question, is it possible to retire a multi-millionaire with just an S&P 500 ETF? The answer is definitely yes. All right, ladies and gentlemen, I want to thank all of you for watching this video. And if you haven't already, please go ahead and hit that like button below, because apparently that's what the YouTube algorithm is all about these days. It's likes. But if you want to keep up with my channel, please remember to subscribe, because I'm dropping videos multiple times a week. I'll see you guys next time.